Judging by the US dollar's weak start to the week, Donald Trump's tariff program is no longer seen as particularly favorable for the American currency. At least the latest memorandum recently published by the US president failed to trigger a victorious dollar rally in the currency market. The document targets China, but also urges Mexico to impose its own tariffs on the Chinese imports. At the same time, the US economy is beginning to show signs of slowing down. Reports released on Friday indicated that business activity had nearly stalled in February. This survey is a leading indicator suggesting that both businesses and the consumers are more and more concerned about the policies of the Trump administration. As a result, the US dollar index dropped to its lowest level in 2 months, falling into the range of 106.10 to 106.62. In other words, after just 1 month of Trump's presidency, the American currency has depreciated by more than 3% compared to its January peak. While markets are increasingly convinced that Trump's tariff threats are merely a negotiation tactic, Europe is preparing to act for real independence from the United States. At least that's the vision of Germany's next Chancellor, Friedrich Merz. Much now depends on how quickly he can form a coalition government and implement reforms to revive Germany's line economy. This could play a key role in shaping the euro's trajectory over the next few months. As a result, on the first trading day after the elections, the euro surged to a 1 month high of 1.0528 and continued to hold gains within the range of 1.0464 to 1.0531. Of course, on a broader scale, the euphoria around the single European currency looks fragile. The new German government is unlikely to trigger a sharp economic boom, as it will have limited tools at its disposal: minor tax incentives, small-scale reforms, and modest investment growth. However, as long as investors believe that Germany has worked and will once again lead to the Eurozone's growth, the euro will assert its strength. This optimistic sentiment could persist for several weeks, at least until the market starts pricing in the US tariffs on European goods, which Trump has promised to implement in early April. If the bearish scenario unfolds, the euro-dollar pair will attempt to break through the technical resistance at 1.0535. A rejection at this level could price back into the consolidation. Interestingly, Friedrich Merz intends to form Germany's new government by April 20, nearly 2 months from now. That's a long wait, and such a delay could push the euro down toward 1.03. The euro may also rise due to the weakening US dollar. As concerned over the US economic growth intensify, the greenback could stay even further. This week, at least 9 Federal Reserve policymakers, along with the representatives from other major central banks, are set to speak. For more details on how economic data impacts the markets, check out our traders calendar. Oil prices are trading mixed today. After a slight 0.4% decline last week, Brent crude remained within the range of $73.5 to $74.30 per barrel on Monday. Among the key downward pressures on the crude prices are potential delay in OPEC Plus production increases, a weekly update from the U.S. Department of Energy, and a statement from Iraq's oil ministry confirming readiness to resume Kurdistan oil exports via a pipeline through Turkey. These factors continue to weigh on the oil market, keeping prices under pressure. At the same time, the ruble-denominated oil price is naturally going down. Given the ruble's advance, the situation is clearly unfavorable for exporters and the national budget. A strong domestic currency means that oil revenues converted into rubles will be lower, and this results in less money flowing into the state treasury. Several factors are currently driving the ruble strength, including the Bank of Russia's tight monetary policy, the approaching peak of a tax payment at the end of the month, and the geopolitical market expectations. However, these geopolitical factors may soon weaken as new sanctions against Russia businesses took effect on a Monday. Specifically, the European Union has cut off 13 Russian banks from the SWIFT system, while EU foreign ministers today approved the 16th round of sanctions against Russia. So that's all for today. We continue to follow developments in the financial markets. Subscribe to our channel and follow news with us. See you!